If you really want to see your costs go down, you need to get economies of scale. And if you can't get economies of scale, you're just shaving around at the edges.
Hey, everybody, and welcome back to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I am Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we're hosting those conversations you won't hear anywhere else about how to make housing more innovative and attainable.
And we're really excited to be partnering with Saul Ewing to bring you some of these smart conversations. If you have an idea for a guest or a show, or have interest in sponsoring especially an episode, email us at podcast@thehousinginsiders.com.
And if you like the show, please give us a review and spread the word. That's how we get the podcast out there, and that's the way we can make more of these great episodes.
All right, guys, I'm so excited about our guest today. I will not be exaggerating when I say he is one of the most influential figures in the modern mortgage lending world. If you are a young listener, I highly recommend listening to some other podcasts Bob has done. His backstory, which we won't have time to get into, is fascinating about how he went from, I believe, a trash collector at some point, all the way to CEO of one of the most important mortgage companies in the entire world. So today, he's widely known for just simplifying and democratizing a lot of complicated lending processes. And he's really made Rocket, who it is today, a leader in digital mortgage solutions.
Yeah, Bob, you retired from Rocket in 2023. And so what we want to do today is kind of go through the experience, the lessons learned all the way back through the RocketMortgage days, maybe even into the Quicken Loans and Rock Financial days. And then also talk about the industry and regulation and what's the future and where do you see the industry going. So thank you so much for being here. Welcome to Housing Insiders.
Thanks for having me. I appreciate it. Look forward to the conversation.
You know, one of the things that I thought of when I was thinking of where to start, this sort of, as John framed it up, where are we now in mortgage? One of the things I've quoted you on repeatedly was the video that you showed when I worked for you around the pit crew, and how an auto racing pit crew has actually added people, added headcount over the years, and dramatically reduced the time in pit from a minute. And then, you show the decades down to now in F1, when you watch one of those races, you're talking about a split second, right? 1 second, 2 seconds. And yet there's more people. And the corollary about digital innovation was we're constantly hearing about fewer people. And yet there is a physical world aspect of sometimes more people can get faster. And so I thought maybe, since we're going to be talking about a lot of the lessons we all learned, I learned from you, I thought maybe we'd start there. And just how do you see that digital innovation relative to people versus technology in our business?
It's funny. You'd mentioned that the other day as we were talking about the podcast. And so last night, actually, out of the blue, I found that video. I used to play a lot. And it starts with a pit stop for a Indy car in 1950. And as I recall, it took 67 seconds for them to put on 4 tires and put in gas and clean off the windshield and whatever else they did. And then they fast forward to 2000, I think it was like 2018, 2019, and it came in and it was 1.9 seconds. So you went from 67 seconds to 1.9 seconds. To your point, there were more people. I remember I used to show that a lot because what it meant to me anyway was because if you'd have told the people in 1950, if you'd have told that pit crew, you know what, we need you to go from 67 seconds to 30 seconds. They'd have looked at you like you had 3 eyes. They'd have thought that was impossible, unattainable. And then if you'd have told them, well, you know what, in 2018, 68 years in the future, they're going to be at 1.9 seconds, their brains would have melted. But I think what that is the power of the possible, and to be able. And so when you watch that, I don't know anything about IndyCar racing, but when you watch that, you can see the compilation of years and years of improvements and innovations and thinking. And I always thought that was really powerful when you think about process and when you think about doing things. And I often ruminate on the fact that when I got in the business, it took pretty much, the standard lock was 30 or 45 days. And lo and behold, the standard lock is still 30 or 45 days. So that's a conundrum. I think to your question, Jeremy, about technology or people, I don't know if there's a formula there. There are times when people are the right attribute for solving a task. There's times when technology is the right attribute. I think it really comes down to thinking. And it comes down to technology is nothing more than a tool. It's the same as a hammer. It's the same as anything. It's a tool to be able to do a job. And technology in and of itself doesn't do a thing. It is technology, it is harnessing great thinking, great ideas, innovation. And if you apply new technologies, you can't just speed up the old way of doing things. That's the mistake. And that's a mistake that a lot of us make. I've certainly made. Again, your question was people or technology. I don't think it's either or, but rather what goal are you trying to solve? What's the right outcome? But you would hope over time you could do more with less people. Now, that doesn't necessarily mean, well, gosh, no one's going to have jobs. It does mean that it frees those people up to do other things and hopefully more higher value things. And that's when you really start to see innovation. You really start to see value creation.
Yeah, one of the things you mentioned that hasn't changed was the rate lock. So I'm curious if you have other things that you're looking at that say, we hear a lot in the mortgage industry about what you said, change, this constant change. But I was wondering if you're looking at things and said, here's actually what's not changing. Here's what's the same about our business and likely to stay the same rather than focusing on what has changed.
Yeah, I think the answer to that is relatively straightforward. People are always going to need homes. You got to live somewhere, and people are going to need to borrow money to get in those homes. I don't think that changes. And I think that should be heartening to those of us in our business. The fundamental demand for what we do is going to remain. Now, how we provide that service, how we provide that money, that's a whole different ballgame. But I think the fun, because there are certain industries and certain businesses where you could make an argument your whole need for living, your whole need for existing goes away. That's not going to happen to mortgage lending anytime soon.
Yeah, I want to ask about a part of the mortgage lending industry that I've been thinking a lot about recently. And if I think about what Quicken has done, if you look at a mortgage lender, they really do three things. One is they attract customers through the door. The second is they manufacture a loan. And then the third is the capital market side. My sort of simplistic way of thinking about it. And amazingly, Quicken / Rocket have revolutionized at least the first two, if not the third, of those three parts of the ecosystem. But what I want to ask about is the first thing. So, I've heard you talk about, before sort of digital mortgage lending, people would get a loan from a bank. And as I was thinking about that, the advantage banks had, call it 40 years ago, is that you had customers physically walking through their door every day to deposit a check or to get cash or do something like that. And so, naturally, when they thought about getting a loan, they walk into a bank, there's a sign, here's the guy to get a loan from. And that's where they got their loan. But then, I think it was Dan's idea to do this mortgage in a box thing where you were sort of mailing things, no longer from a bank, but like really mailing them more broadly, which is a way to get to customers that was very different than a bank. And eventually, advertising and Rocket and Quicken, exceptional advertisers, Super Bowl ads, so on and so forth, that really was never considered something that mortgage lenders would do, advertise a mortgage. So I'm sort of thinking about one, I'm just kind of curious to get your perspective on that kind of shift of the industry from being a very in-person way of marketing or getting people to get a mortgage to a digital marketing type of thing. But I'm also really curious today where marketing looks so different given social media. There are a lot of people that I haven't been in a bank probably for 2 years. I probably have been on my bank's mobile app a couple of times, but I've been on far other websites way more frequently. I watch the Super Bowl once a year. So anyway, sorry, a long-winded question of like, how do you see Quicken and Rocket's transformation of getting customers through the door, and like how do you anticipate that changing in kind of this even more modern digital world?
A number of things. And one of the things that I'd like to chat about is, in I'm going somewhere with this, so this is a placeholder for a later part of our conversation. Is one of the conundrums is it's about, I don't know, it depends who you ask, costs about $13,000 a loan to originate a loan, something like that. Does that sound about kind of the numbers you guys hear? The conundrum is, wait, the industry has literally spent tens of billions of dollars on technology. We've gone through the internet revolution. We've gone through mobile. We're now entering into AI. I also want to talk about that because I think that's going to be the singular most profound thing in our lifetimes. So we'll come back to that. But back to your question, So Dan, one of the attributes, there's so many great attributes of Dan, and I see it as one of the honors of my life, honestly. And I don't try to fall to hyperbole all the time, but I mean this was getting to watch him operate. It was special. He always thought big. It's not like everything he thought about correctly, but he was right often enough, of course. But he thought big. He wasn't interested in going from 3 branches to 4 branches. He wasn't interested in going from 2 states to 3 states. He always was thinking like, how am I the largest lender in the country, the largest 50-state lender? How do I have 10%, 20%, 30% share? How do we go there? That was always his orientation. When he made his changes in Detroit, it wasn't like, I'm going to buy a building or two and really hope to make a change. Like, I'm going to buy 150 of them. And we're going to do retail and commercial, and he had the audacious, most people would be like, are you out of your mind? And quite frankly, a few times I think he was, but I think oftentimes the real revolutionaries are thinking about things in a different way, at a different level of audacity than others. Dan was thinking about that. I think he intuitively understood. He couldn't have mapped out back in 1996, 7, hey, here's exactly how this is going to unfold. But he intuitively understood when he saw the internet for the first time that instantly from one location you could unlock all 50 states. Whereas previously you needed to have a brick and mortar in this town and then that town and hire these loan officers and those loan officers and set up this processor and that processor. It didn't scale. I think he understood the scalability of the internet immediately and intrinsically and intuitively. And so we quickly went down that road to get licensed in all 50 states, to set up the storefront. We had brick and mortar at the time, but about 4 or 5 years later, we shut that down. Dan took a very much of a burn the boats mentality. He's like, as long as we have these brick and mortar, we're still going to serve that. By freeing ourselves up, we became a 50-state centralized mortgage lender. And we all know how that turned out. And so I think that was really some of the profound things that occurred. And what it allowed was the much easier access for people to get a home loan, certainly in a refinance, but also in a purchase. You now could just sit in your pajamas and start the process. So it really democratized that and made it easier. And you think about the billions and billions and billions of dollars that it's saved Americans by making the refinancing and financing process easier. Whereas historically, you might have been 2 points out of the money, but you're like, I got to gather up my stuff and I got to go to this place and get judged by the person. And now people realize that it was a much easier thing. And, same thing with, like, if you think about Amazon, if you wanted to buy a part, a tool or something 30 years ago, you had to go find your local plumbing store, your local whatever store, and maybe they didn't have it, maybe they did it. And now we know how it goes. You just type the thing in and it comes up and you get it. That's democratized access to things in a way that goes well beyond price as you think about its value to us as consumers.
So one of the things you mentioned in there that caught my attention was the way that Dan was looking at his big, ambitious, audacious vision. And then, the team you were on to help make that possible. Can you talk a little bit about timing and patience? It can be hard to have ambition and audacious goals, but then also be patient. And then there's times when you shouldn't be patient and times when you should. And how did you balance some of those things when you were hearing these transformational ideas and then you're on the team that has to bring those to reality? And then how do you set expectations and actually go after them?
Well, Jeremy, you certainly spent a little time at Rocket, so our isms. A couple of them that come to mind is money and numbers follow, they do not lead, and you'll see it when you believe it. And so we had these 19 isms, and they represented things that were important to us. But when you think about money and numbers follow, they do not lead. That's really the antithesis of how most businesses are run. Most businesses are run, here's my 5-year plan, here's my quarterly projections, here's my budget, and they're like, I'm trying to earn a 17% ROI or something like that. So you're basically saying, for every dollar I spend today or every bit of effort I spend today, I expect Y payoff. And I need to see that coming in. So essentially, the goal was a specific monetary return. And so Dan turned that on its head and said, how about this? What if you're just great? then your return might be infinite, or many multiples of some kind of simple to put into an Excel spreadsheet return. He always cautioned us against spreadsheet thinking. That doesn't mean you're not thoughtful about things, but he was like, you'll get what the greedy man wants. That means spending money. That means building things when you don't necessarily know exactly what the return will be. That means taking chances and building things. That means your cost to service is higher than other people. Why? Because you kept everybody in the United States, and you believe that that customer relationship and that customer experience is going to pay itself off, because people will so want to stay with you that they'll refinance with you in a minute. But I can measure the fact that your cost of service is $67 and mine is $91, so therefore I'm better than you. But what you're missing is that your retention stinks, and I'm making $10,000 a loan when I retain the loan. So it's, if you get away from spreadsheet thinking and start to think about really opening your mind around real value creation, not just simplified returns like you put on your green eye shade, then you start to operate in a different world. Dan operated in that world, and I think got a lot of us to come along for the ride and start to change our thinking into that approach. And so, you know that, Jeremy, that's how we ran that business. We spent money on things that other people would think was crazy. Why would you do things in the office that were really, really expensive to create a really cool environment? But then you realize, like, people are really happy and excited, and what they then give back is many multiples of whatever you spent. So yeah, I'm giving you all these Danisms, and I think this one comes from, I don't know who this one comes, but not everything that can be counted counts, and not everything that counts can be counted. Dan lived that way. When everything has to be, when you have to count the beans on everything, well, then you're going to live in a limited box. But when you start to get beyond that, it's usually a special person that thinks that way. You start to get extraordinary returns.
Oh, you'll be happy to know that I have my ISM book right over here. So, and I encourage any listener that is at a conference where Rocket is, be sure to pick up a copy, because it is really fantastic. I want to ask about an industry trend, and I don't mean to ask this in terms of Rocket, because I know you're not involved in the day-to-day activities of Rocket strategy, but this seems to be a sort of a widening of the aperture that's happening in the industry, which is a lot of lenders are starting to combine their businesses with the front end and the realtors, the search engines. And so, Rocket and Redfin, we've seen Movoto recently purchased by Lower. There seems to be this trend of merging the sort of front end home search platform with the sort of mortgage process as well. And I mean, Zillow has its own lender, for example, is another example of this. And I'm just wondering what your thoughts are on that. Is this just a recognition that the importance of, like, the loan officer realtor relationship has gone down and people are searching for homes digitally, and that's where you're going to find people that need mortgages? Or is there something bigger that the industry is starting to recognize relative to that?
I tend to think it's something bigger. If you buy a home, your cost to buying that home are about 10 points of the home value. So if you buy a $400,000 home, literally your transaction costs are about $40,000. Now, people don't think about it that way, because 6 points of that is the realtor commissions that the seller's paying, but really the buyer's paying it because it's in the sales price. It just is. And then you've got another, call it 3 points, that is mortgage lending. And then the remaining point is title and other costs like that. You're at about 10 points. Well, where were we 20 years ago? We were at 10 points. Where were we at 30 years ago? We were at 10 points. Something's wrong with this calculus. Something's wrong. Where most industries scale, most industries, you really see the economies of scale take over. I think we can talk about it. I have a number of thoughts about that. But if we're going to disrupt that very inconvenient truth, because I think one of the other things we'll talk a little bit about today is, housing and why housing's unaffordable. And there's a whole bunch of reasons. There's not a simple silver bullet. But one of them is, as long as when you buy a home, you're 10 points underwater from the get-go. I mean, you can, again, debate how I got there, but you get my point. Well, why not 9? Why not 8? Why not that point or two goes into the homeowner's pocket through efficiencies in the rest of the industry? And so to get there, we're going to have to break, to use an overused business term, we're going to have to break the paradigm. And I think that's going to mean things like, marrying lenders and realtors and finding real efficiencies and economies. And there's no magic bullet, but you can see when you're talking about things like that, because, and I want to explore this if you guys are interested, you know what one of the biggest costs to all of this is? Advertising. Whether it's the realtor or the mortgage lender, they're all spending enormous sums trying to get the client. Why don't we see the kind of consolidation that we see in other industries where those marketing costs can be defrayed by a larger number of people, so you're not paying that? And so you're going to have to think about things differently. And whether it's Rocket or Redfin, and again, to your point, I have no inside knowledge as to the strategy that they're going down, but you can see that they're trying to break that paradigm. They're trying to think about things differently, because for them to gain market share, and anybody to gain market share, you have to come up with a value offering to consumers that's better than the other person. Otherwise, how are you expected to get more share? And that's either price, service, or product. And I think that by combining those, they'll be able to touch on all three.
Yeah, I agree. Let's dig into that, because one of the things around the business model like you said, is it's a commodity. So in many ways, price is negotiable within some of those levers like origination costs and sales and marketing, but in other ways it's kind of set by your investors in this business model. And so you see fewer and fewer levers the less and less you control about that cost of delivery or sales and marketing. And I often heard it said, oh, well, Rocket's costs around marketing and sales look like a big number, but essentially it's just collecting what another mortgage lender might pay out in commissions to 3,000 loan officers who are hitting the pavement every day. And I'm curious if you think that's true relative to the scale and the cost of sales and marketing. And then we can talk a little bit about the different ways in which that business comes in.
Yeah, I think that's right, Jeremy. If you and I started Jeremy and Bob's Mortgage Hut tomorrow, our marketing budget would be 10 cents and some pocket lint. And so the way that we'd acquire customers is we'd try to go hire loan officers who have have influence in their community, and their relationships. That essentially is our marketing budget. We can call it LO comp, but it's really our marketing budget. It's marketing and sales. And so then if you find a company like Rocket or others, the calculus is different. You've got marketing, but because their loan officers are closing many multiples of loans relative to your traditional distributed company, it's different from that. And so Rocket has seen scale. They've actually seen some economies of scale, and it's not a surprise that they're the largest retail lender in the country. And so that's exactly right. However, what's interesting though is, even if you look at Rocket's market share, it's still single digits. And so most industries don't look like this. Most industries, the largest entity has 30% share, and the next one has 20%, and then 10, and then it fragments from there. But you see consolidation. If you look at autos, or if you name the industry. So why does our industry have literally 10,000 plus mortgage lenders, and are we so fragmented? And there's a number of reasons. And I think it's funny, sometimes your greatest attribute is also potentially a liability. And in mortgage lending, one of the greatest attributes we have is the GSEs. It's great because they provide access to the global pool of money. So we're able to get cheap money relatively and give Americans 30-year fixed mortgages that are pretty attractive rates. And that's a wonderful thing. I think it's the envy of the world, our mortgage finance system. The downside to that, though, is that so Bob and Jeremy's Mortgage Hut, clearly we're going to start this tomorrow. We could set up shop, and literally from a price perspective and a product perspective, we could pretty much compete with Wells Fargo, Rocket, UWM, you name it, right? Name me another industry where you can do that, where a mom and pop can, we couldn't start a car company tomorrow and compete with General Motors. That democratization of price and product comes from Fannie and Freddie. And again, I think net, that's a good thing. But the problem with that, or at least the challenge with that, is that means then you have thousands and thousands of entities fighting over the same loan, spending large sums of marketing to do so. Because when you look at the $13,000 or whatever it is cost to originate, I used to fall into this trap and be like, gosh darn it, if we could just, underwrite this many more loans or reduce credit costs by this much or something like that. But then it dawned on me, wait a second, of that $13,000 number or whatever, only about $1,500 of it is ops cost. You could literally take that to zero and you still have a problem. So where's most of the money? You probably heard this, Jeremy, when you were at Rocket. Forgive all my Rocketisms. I've been retired a few years, so it's all ready to spew out. But Willie Sutton, I think it was Willie Sutton, but he was a famous bank robber, and they said, "Why do you rob banks?" He says, "Because that's where the money is." So it's like, where's the money in that cost to originate? And a huge chunk of it is sales and marketing, because no one's able to get true economies of scale. It's not like you have a General Motors out there that can all of a sudden, instead of spending $3,000 or $4,000 in sales and marketing per loan or more, they only spend $1,000. And now you start to see, as long as things remain as fragmented as they are in industry, and they are very fragmented, I think you're going to see that same conundrum occur.
Yeah, it's really interesting as you sort of think about the sort of pipeline of becoming a homeowner. When you get to the capital markets point, that's the simplest and most scaled sort of thing, because you have one point to access the capital markets. But when people start to shop for a home, it starts in what I consider maybe the most problematic, which is the realtor industry is so fragmented, right? It's 2.4 million independent contractors out there hustling to get leads. My kids go to school and there's like 5 realtors that are always advertising at every school event, right? So they're just constantly out there. They've got signs in yards, and that's a really hard place to disrupt. But that's also very expensive for each of them to do that marketing. But if that's where the process starts in this sort of very fragmented place, how do you even start consolidating it, right? Because now realtors are going to have their own loan officer that they work with. And as we know, that's probably the primary place that leads are generated in this industry. And so, and then, they've got a huge percentage of the cost. So I wonder whether or not you can get really good at marketing, you get really good at manufacturing loans, but you're still trying to market ultimately to realtors who are really fragmented. I don't, do you agree with that?
Yeah, gosh, it's a sticky issue. I mean, some of it is because the very fact that a realtor's business, to a large extent, is a tactile business, meaning you need to be with that person in that physical property. People can say, sure, we can do this online, and some of that got done in COVID. And sure, I mean, I think there's a place, but I think most people literally want to walk through a home and look at it and smell it and look out the back door and whatever they need to do. And as such, and because it's such a big transaction, you need that comforting that comes from a human being that I'm doing the right thing. And so I think both those things lend themselves to a realtor being a in-person role. And as such, then if you think about scale, well, guess what? If you literally have to drive people around and show homes and things like that, you're limited to a certain number of transactions. When you see realtors that close 20 transactions a month, they're not doing that by themselves. They usually have teams. No shade on that. I'm just saying that it's a very labor intensive role. Until that gets disintermediated in a way where people get comfortable buying without physically going to properties, I think that's going to be part of it. The other thing is, because it's such a lucrative transaction when it does occur, and because there's very little barrier to entry, you have a couple million. Now, we know that a relatively small fraction of those couple million is doing 80% of the transactions or whatever that number is. But that also leads to some of that fragmentation that you see. And then I also think the other thing, sometimes your structures, I'm a big incentives person. And, I'll steal from Charlie Munger. He said, show me the incentives and I'll tell you the outcome. And I very much believe that. And so when you think about the way the compensation is structured, it's structured as a percentage. It's not a dollar. It's not like they put a dollar price tag. It's a percentage. So what that means is it's really pro-cyclical in the sense that every time home prices go up, they get a raise. And I also think that's a fundamental kind of a thing. So, home prices before the COVID were, I don't know, what were they, 270? You guys know the numbers better than I. And then post COVID, they're up 50, 60, $70,000. So if you really think about it, you're talking about a $4,000 raise for the realtors in 3 years. for the same role. And I'm not picking on realtors. I'm just saying that sometimes back in the 70s and 80s, if you looked at your econ and we had huge problems with inflation, one of the problems were a lot of contracts, union contracts and the like, were tied to the cost of living, cost of COLA contracts, cost of living allowances. What that meant, though, is that every time inflation went up, they automatically got a raise, which kicked inflation up, which gave them a raise. And so you had this very pro-cyclical sort of a thing. And I think there's a bit of that going on. So look, it's beyond my pay grade to solve the problem. And that's why I go back to your earlier question, whether it's Rocket or Zillow or Redfin or whomever, I think there are ways to consolidate these things, provide really high quality service, really high quality value to consumers for cheaper.
I think one of the things you just hit on that we can't avoid talking about in this industry and with this tricky and delicate balance that you just described is that underlying a lot of what we just talked about, LO comp, realtor commissions, other types of GSE delivery related pieces are all in some way regulation or regulatory reform. And so as we think about these different mechanisms and levers, either of lowering costs, speeding things up, innovation, we can't have this conversation without asking about regulatory reform. It's this constant in our industry. But what John and I usually hear from people is regulation needs to be more clear and just remove regulation. These sort of big generic statements without specificity. Which regulations, where, why, when? And so what's your take over the years on how you had to come head to head with regulation all the time? We had to digitize it or bake it into the technology when we were making changes or innovating at Rocket. So I'll just start there and then we can dig in a little further. But how do you approach something like that and actually make it actionable?
I think about two terms that are probably cousins to each other. One is regulation, the other is structure. So, where does structure end and regulation begin and vice versa? I don't always have the answer. But what I mean by that is, so the fact that you got, so Fannie and Freddie charge, or they have a minimum base servicing fee of 25 basis points. Is that regulation? No, that's really structure. So what that means then is that every single mortgage created requires somebody with a very large amount of capital to apply that capital to the industry. That somebody decided somewhere along the line, 25 basis, and maybe that made sense 30 years ago. I'm not putting shade on that. I'm just saying that, so, your average mortgage now is around 400 grand. That means $1,000 of capital, really more than that, $1,200, $1,400 of capital day one must be applied. And that capital has a price. Why isn't it 10 basis points? The cost of service is probably $70, $80, $90. You don't need 1,000. You're creating a giant IO. Why? Why are we doing that? Think about what that had the downstream. First of all, it limits the number of people who can play in that thing. Second of all, it means there's an extraordinary amount of capital. You got companies that are largely manufacturing companies, meaning I originate or service mortgage. When I say service, I mean do the actual role of collecting payments and escrows and all that kind of stuff, versus the capital markets component of where am I going to come up with a few $1 billion to hold this IO and hedge this IO. That's all very structural, but it has a price. It has a substantial price in that it reduces competition, increases fragmentation, things like that. So it's much harder to go direct because you need an intermediary to service the loan. Why? Because it's so capital intensive. That is a structural reality. And then because of that, you have Fannie and Freddie saying, they don't say it overtly, but they're not going to let somebody have 50% market share. They don't want to do that for a number of reasons, some of which are great. But that also means then that there's this overlying structural reason that we're a highly fragmented industry. And I go back to, if you really want to see your costs go down, you need to get economies of scale. And if you can't get economies of scale, then you're just shaving around at the edges. Well, we can say, oh gosh, credit costs are so, they went from $70 to $80. And we should address that. But that's not the elephant in the room. That's not the elephant in the room. And we're being distracted when we think about regulation instead of thinking about structure. And there's a million things we can talk about from a structure standpoint. Like if you were to come from Mars and you were to develop the mortgage lending industry and the capital markets that attend to it, and your goal was to create the lowest cost structure, you build it differently. And so, again, no one did anything wrong. This is the amalgamation of a lot of things. Many of things were really, really good because there are a lot of things that go very, very well. But a lot of them don't make sense and have really unintended consequences.
That's such a well articulated point. It's interesting when structure is supporting $1 trillion market, right? That structure in some ways, I would say ossified. I don't know if that's the right word, but it just becomes so essential that it's so hard to change. But there's so many parts of that sort of central capital market structure. The one that you just mentioned, I often think about when I like to pick on is like you underwrite a loan, you've got to do a condo review. You got to do a condo review, you got to follow the condo rules. That's going to add 2 to 3 weeks. That's part of the structure, if you will. It feels like a changeable part of the structure, but because the structure is so big and so important, that the risk of changing even a small part of that structure becomes, it just becomes terrifying, I
Well,
think, to a lot of
you know,
people.
it's so funny. That's so very well said. I go back to incentives. So let's think about this for a second. The three of us now, let's say we work at Fannie Mae, we work at Freddie Mac, we work for FHFA, we work at FHA. You pick your acronym. And so what are our incentives? We're not incented in any way, monetarily, career-wise, in any way to take on some level of risk or to think innovatively. We can only get in trouble if we think that way. And again, some of those folks are thinking that way, so God bless them. But I mean, risk management, risk mitigation, you'll never get in trouble for asking for another QC review. Right? You would get in trouble if you said, "Gosh, we think we overdid it here," because people emphasize the things that can be measured. And again, this is a Dan learning. We overemphasize what we can count, and we underestimate what we can't. And Dan would often remind us, your biggest costs don't show up in your P&L. And so, I would, when I was leading Rocket and I'd talk with brokers, I'd say, "What's your biggest cost?" And it was a trick question because they'd be like, "Well, marketing, LO comp, leases, credit reports, whatever." That's what they'd say. All of them are big costs. I'm like, not even close. Your biggest cost is fallout. It is when you bring in, because it's two costs. First of all, it is cost of the time and money you spent that you'll never recoup. But the bigger cost is the opportunity cost. That didn't close, and therefore you didn't get the big commission or you didn't get the big payout at the end of that. But that doesn't show up on a P&L. You'll never see fallout costs on a P&L. And those are, if you looked at employee costs, you just see what you paid people. The big cost you don't see is if you had a high amount of turnover, where's turnover cost? Not only what retraining, all that kind of stuff, morale, where's that cost? It's nowhere, but it's a huge one. And so really, if you're an adept business person, you're just intuitively in tune with the costs that don't show up on a P&L, that never materialize on an Excel spreadsheet. And again, Dan was so brilliant in having us think about that. And I think that, I think that that's a really important part of that answer.
When you think back to that career path and eventually leading to being the CEO of Rocket Mortgage, is there something you now think about that you would focus on a lot more? Is there something that, going through that process and being outside of the mortgage company structure, that you look back and you're like, man, I should have focused on that, spent more time on that, or I overlooked that cost or that item or that thing?
Oh gosh, there's a lot, but nothing really that is profound. I can tell you in a second what I think about today. I think it would have been really around even pushing harder and faster toward getting loans ready to be able to close in days, in hours. By the way, I think the team and we did a lot there. And so there was a lot of good things there. But, I always thought it was, and it still is remarkable that most, like, let's simplify it and talk about a refinance. Why shouldn't most refinances be ready to close in 48 hours? When I say ready to close, leave trade aside and all that kind of stuff. But why shouldn't most of them be there? Now, you can talk about a whole bunch of reasons and we can ensure, but I mean, it is very doable. Well, I've seen it done. So it's not like, oh, we can't go to the moon on a bicycle. So we can absolutely do that. But why aren't we doing it at scale? And there's a bunch of reasons for that. But the reason I think speed, and even on a purchase, we should be ready to close that loan in 3, 4, 5 days. And that now the buyer and seller may not want to render that transaction for 30 days, but people should be ready in 5, meaning like you're done. You don't need to worry about it. Hey, realtor, you don't need to worry about it. We're done. Here's your certificate. And the fact that we're not there as an industry, but we've made progress, but I would argue not as much as we should, I think is something that could have been more done. As far as today, sometimes I get AI. I'm beyond obsessed with AI. And on a daily basis, I am gobsmacked. Is that a term? Gobsmacked. I'm blown away. Every day, so I do something or learn something or see something where I'm like, I can't believe I live in this world where this is happening. And AI is going to transform every industry, but certainly mortgage in ways you can't even imagine. And if you wanted a piece of advice, if somebody's listening out there, if you run a company, I'd make sure your leadership team is very fluent in using AI, writing prompts, understanding how to take documents and do those kinds of things. I would tell you some are fluent and many are like, yeah, I had to do a poem for me one time. Like, I mean, that's malpractice. Your leadership team should be fluent and should be spending many hours of every day using AI to transform the way they operate and think. I've recently downloaded Fannie and Freddie's servicing and seller guides, and I'm giving it scenarios and having ChatGPT underwrite loans against the guides, and it does so in 20 seconds. And I say, ask me the questions I didn't ask, and it asks me like, okay, you put in overtime. How much can you show? Can you show the 12 months? Oh, I see that you put in child support. Can you show the 3 years continuance? Like, it's doing all this stuff for me. And you know this, Jeremy. At Rocket, we spent zillions of dollars on technology to do and teams to do this. And now for $20 a month, here it comes. It is profound. And those who are not using this at scale and deeply fluent with it and understanding are going to get smoked by those who do. And I will say, I lived through the year like, if you're not on the internet, you're going to be dead. And there's all these things. But I really do think this thing is happening so fast and it is so profound and it is so life changing in many ways, both amazing and scary. And I don't think people have a clue how fast it's coming.
I am so excited to dive into that because there's so many ways in which it can transform the industry, and I'd love to hear your thoughts on it. But before we do that, we better take a brief break here and have a word for our sponsors. And when we come back, we'll cover AI and talk more about where we think the industry is going.
Today's sponsor is Saul Ewing. Consumer financial services companies face a constant onslaught of litigation and risk arising from a multitude of federal and state consumer protection laws. They also contend with enforcement actions from federal and state regulators and agencies. So navigating these obstacles while managing legal costs in today's crowded and shifting market presents unique challenges for these institutions. Attorneys at Saul Ewing's consumer financial services litigation practice are sensitive to these challenges and provide their clients with practical, industry-specific advice and counsel. To learn more, go to saul.com and look under capabilities. Welcome back. We're here with Bob Walters talking where we are going in the mortgage industry. And we just left off on AI, so we're going to jump back in there, Bob. And I'll frame it up this way because we want to know what you just mentioned the power and the capability and what leaders need to be focused on. What I was always falling back on was one thing I learned that you taught me in the capital markets at Rocket, which was everybody underestimates the complexity of mortgage. And they often talk about what the threats are to mortgage without really appreciating how complex it is. What you just described about AI sounds like a direct, addressable tool for the complexity of mortgage. So how do you see mortgage today in terms of what AI may bring, threaten business models, or otherwise give us that we haven't needed to worry about before today?
Yeah, you just made me think of something I used to share all the time. You probably had to hear it from me a few times, so forgive me. But this made such an indelible imprint on me when I saw this one time, and I'll share it with you guys. And I think it's germane to what we're talking about. So if we had one six-sided die and I rolled it, what are the possible number of outcomes? 6. Okay, the math's about to get harder. Now I have 2 and I roll it. How many possible outcomes? I won't have
36?
36.
I mean, yeah.
36. It's really the number of dice to the sixth power. And so 3 dice, 216, 4 is 1,000 something, 20 dice. Now 20. So I could hold 20 dice in both hands. I'm cupping my hands. I could hold 20 dice. It's not that many dice. I roll 20 dice. What are the possible number of outcomes? And the answer is 4 quadrillion. 4 quadrillion. So that is 4 times 1,000 trillion. I mean, it's just this unfair. So what's my point to this? Why exercise? It just shows you how quickly permutations of things exponentially grow. 26-sided dice lead to 4 quadrillion permutations of outcomes. What happens when you introduce thousands of loans of individual humans to Fannie's guidelines, to Freddie's guidelines, to FHA guidelines? Some are primary, some are secondary, some on and on and on and on and on. It makes 4 quadrillion seem like, child's play. So my point to that is when you're dealing with that level of complexity, this is why people who are like, I'm just going to write a couple lines of code and solve this little mortgage origination thing for you, they quickly run straight into a wall. And so this is where we've required lots and lots of human beings to sort these things out individually in a very inefficient but effective way. And so I do think, to your point, I think AI is going to make major advances in this. If there's anything that computers can do, it can solve complexity at scale quickly. So it'll be able to do a lot of those things. I think there's a lot of other ways to approach it. But that is also, we talked reasons why our industry is so fragmented. One of it is because of the inability to compete on price easily because of the agencies that democratize that. But the other is because of the sheer complexity of closing a mortgage loan. We used to try to think about things like, well, let's just find the simplest loan, a rate and term refi for somebody with a DTI less than X, whatever. And even then you're like, oh gosh, they got a divorce, or oh wait, hold on a second. Every loan has a snowflake quality to it and made it challenging. But if there is ever a technology that has come along that is going to help us address this at scale, and I keep using that word, it is going to be AI.
Yeah, without a doubt. I mean, and I want to mention that the 20 dice that you mentioned is a structural issue too, right? I mean, there was a time in the mortgage industry when people said, well, look, if somebody's got a 740 credit score, I don't give a shit what kind of overtime pay they have. Like, they're approved because there's no underwriting model in the world that you give it a 740 credit score, the probability of default is going to be higher than whatever your risk standard is. And so a lot of those complexities are structural. But to your point, keep the structural complexity. AI is just going to overwhelm that immediately. I'm curious to get your thoughts on another part. And it kind of goes back to something you said earlier about the realtor's job is to be in person because part of it, they got to go show the home, but also part of it is they're the therapist. There's an interpersonal aspect of the transaction. I'm right there with you. Like, there is nothing that's sort of process based that AI is not replacing right now and should have completely replaced in a year. I mean, all of that stuff should be just AI based. But there is this sort of human component that's a big part of the industry too. I'm reading stories now about people falling in love with AI. Even Mark Zuckerberg saying that, you need 15 friends, get 3 and then, go online and make 12 other friends with AI bots. So I'm kind of curious, like, in your exploration of AI, do you think it's going to move beyond the replacing OCR for documents and making underwriting smoother and quicker, or whatever? Do you think it's going to get into some of those more interpersonal parts of the industry and really kind of cut those costs?
We're entering into the futuristic component of the discussion. I think there are more thoughtful people than I to answer this, but my 2 cents, for whatever it's worth, is for sure. Now, when, I don't know, but for sure, we can already. I was playing around with looking at some properties in another state. And so you get a realtor who then basically they sign you up and they send you new listings. It's just automated, right? It's just like every time there's a new listing in your price range, it just fires it to you. So I get these things on the regular. And some of the homes are homes, and some of the homes are actually spec builds that have yet to be built. I'm now at a place where I can't tell the difference because they've done a rendering about what it's going to look like. It used to be, I'm like, yeah, I can tell. There were these clues. You could just tell. I mean, yes, sometimes I can, but oftentimes I'm like, is Yes, no, is it? There's been a couple times I was fooled. I talked to the realtor and I said, that's a rendering. They're like, no, that's the house, and vice versa. My point to that is, I mean, we're not that far away from when you could see a video of someone, you think you're literally speaking to that person and you're not. And I mean, these things are all very scary in a lot of ways. And again, above my pay grade. But you bring up a really important point. And the important point is that there's a functional part of a job and then there's an emotional part of a job. And some have more functional and more emotional. But for example, if you go to a financial planner, I mean, for the most part, you could just throw your money into a couple of S&P 500 ETFs and be fine. But the real value often that a good financial planner will provide you is counselor. When you're freaking out and you want to sell, they'll talk you out of it and calm you down. When your Uncle Louie tells you to go buy something crazy, they'll be like, maybe let's think about it, or buy a smaller portion, or whatever the case may be. Or they'll talk like, let's save more, you can do it. Those are all very emotional things. Those well beyond just, financial theory. And it's very important. And to your point, I think with a realtor, it's a very emotional transaction. You're going to live here, or this is a home I'm selling. How dare they say my carpet's ugly? I hate them. Like all those kinds of things. And so they provide a lot of value there. Will AI be able to handle those complex transactions? Probably someday, but I tend to think that's a bit down the line. But again, probably faster than a lot of us think.
I'd like to ask a question you just made me think of with AI's capabilities, and it'll take us into another big topic that comes up on the podcast a lot, and I'm curious your take on it, which is the supply side. And I was thinking about different ways to ask you about it, but the way you just implied technology is capable of all of these really impressive kind of massive problem solving capabilities. When I think of AI in housing, one of the questions I've always been curious about is, can AI design a better house? One of the things that I wanted to pose this way is, does that matter in your opinion? Meaning, do you see the supply side as a product problem, a technology manufacturing problem? Do you see it as a simple supply and demand problem at any cost? And I'm just curious because we were talking about AI. I don't want to take us too far down the supply side, even though I do have some questions about it. I wanted to ask it more in the way you were talking about playing around with AI. As you play around with it, these design things, these creative things, going beyond the process, do you see it doing creative things that unlock entirely new ways to build and manufacture things from a mortgage to a house?
Oh gosh, 100%. So I'm renovating a house right now. By the way, spoiler alert, don't do that. So I've got, as part of that, you have an architect and you have a builder and you have a designer. And I learned about this new person called a renderer. And a renderer is the one that when you say, I'd like the brick to be this color, or I'd like the window to be there, or whatever, they render the property. Like we were talking about earlier, here's what it's going to look like when you do it. By the way, astounding how good it is. And when I first saw it, I was like, that's amazing. Well, you know what I now do? I still use them, but what I'll now do is I'll take a picture of the property and I'll put it into Chat GPT. And again, you could use whatever one you want. And I'll say, first of all, I could be specific. Render this with a white stone face. Render this with a gray stucco. Whatever. Put a fountain in the front. Add windows. You can do those things, or you can say, so you're my architect. Suggest 3 different really high quality looks that would give me a contemporary feel in this house. And it'll do it. And then you could say, I really like the third one. Render me 3 more that are a lot like the third one. I really like the second one. Render me 3. And you're basically like getting better and better and better. And it's $20 a doggone month. This is Jetson stuff. And for those of you who are younger, that used to be a cartoon. It's amazing. I was talking to my builder and the on-site project guy, and he was saying that, like, if you take out a load-bearing wall, what they have to do is they have to send out all the dimensions. The span is this, the columns are this, engineering stuff I don't know anything about. And they would send it to the architect, who'd send it to the engineer, and they'd come out and they'd give you the calculations of the load-bearing changes you'd need to make. Well, he still has to do that, I think, by law, but he now puts the dimensions into Chat GPT and they give it to him instantly. And he actually had the other day where he did it, the engineer did it, and the engineer was wrong by a little bit, and ChatGPT did it. So my point is, those are just a couple of use cases where you're seeing things. It's changing everything. It's increasing the speed of everything. It's changing the cost of everything. There's a lot of reasons, and very valid reasons, to be scared about this. But it also is going to have, I think, a lot of positive ramifications. And I'm hopeful that we'll see those really help see the mortgage finance in the supply of housing.
Well, given it's beyond all of our pay grade, but I'm sure you think a lot about it, so I'll just take Jeremy's bait a little bit on the supply issue. Any general observations that you have on things that we should be doing? I don't know if it's the mortgage industry. I'm guessing it's definitely not, but anything that could be done to improve supply. And just a hint: the answer is everybody should move to Detroit.
Yeah, here's a couple of thoughts. And clearly, it's a problem. It's a very real problem. I tend to think capitalism is going to sort it out because there's one thing that people really like, and that is money. And so, if there are ways that people can make money to solve this problem, they'll do so. The other thing to point out is, unlike other supply and demand imbalances that can be rectified very quickly, just because of the long cycle of obtaining land and developing land and building houses, this is a 5+ year cycle. So it's just like one of those things that doesn't rectify itself very quickly, but I think it will. And I think the other thing is, I think a lot of our municipalities have become addicted to things like impact fees. And so a significant portion of their municipal revenue comes from things like this. And so it's added to the cost, and I think something to be mindful of. The other thing is the NIMBY attitude in a lot of our cases. We're like, I'm here, now I don't want anybody else building here. That's part of it. And I guess the last thing I'd say is something that probably isn't going to be that palatable, but it's true. And that is, if you want to buy a house in Los Angeles or New York City, I mean, unless you won the lottery or you make Jeremy kind of money, like you're not doing that. Then again, there's plenty of places in Kansas, certainly here in Detroit, lots of places where homes are much more modestly priced. Now, if someone's like, that's not fair, I want to live in Los Angeles. Well, I guess I get it. But if you want to go to the most popular bar in town, you don't always get in. So I think that's certainly part of it. I mean, the reality is that there's reasons that some of those areas are so popular and the supply, and there was so much demand. But come to these other areas where things are more balanced, and you're going to find housing in a better place. And I'm not minimizing it. It's still a challenge, and I still think there'll be a lot of opportunities. I guess the last thing I'll say is this: there's something coming starting now, but it's coming, and it's going to come over the next 20, 30 years. That's going to be profound. And that is going to be the biggest wealth transfer in human history. As the baby boomers pass on, their multi trillion dollar wealth is going to be passed down. And it's going to be passed down to their heirs. It's going to be passed down to charities. It's going to be passed back to government through those estate taxes. But make no bones about it, if you follow those gigantic, unimaginable flows of money, and especially if you start to think about how that money will course through housing, it's going to also have a pretty significant impact. I can't tell you here's exactly how it's going to play out, but trust me, that is going to be a major demographic financial trend.
Yeah, absolutely. One of the things that, Bob, I was able to do was to reach out to some of our friends and colleagues to ask them what they wanted to know, if they could still ask you. And the overwhelming theme, by the way, was that everyone I spoke to misses working for you and learning from you. And so these lessons are great and really cool. So we have a couple just quick questions that we'll fire away. But one of the most common questions I got was, is there something that you're seeing? Now, you mentioned AI, so we obviously have that one as the top of the list. But is there a company you're seeing, a platform you're seeing, or a piece of the transaction you've identified, looking across the industry as you do and consulting and advising as you do, that stands out to you? This company or this platform or this piece of the transaction is really what's next, and everyone should know. And obviously, we're controlling for AI here because we already talked about it. But is there something else that comes to mind?
Certainly, the place I worked for a long time, I think, is in a pretty cool spot. But I'll leave that aside. This might sound like a cop-out answer, but I mean it. The firm that I was always the most afraid of was the one I hadn't heard of yet. And I know that sounds like a cop out, but in 2000, did anyone see Google coming? Like it sounded just like a silly little word, Google. People would just laugh. 4 years ago, I didn't know what a NVIDIA was. Never, what the heck is a NVIDIA? So I think there's a bunch of firms in the mortgage space and the mortgage finance space that are doing interesting things, but I'm not aware of anybody where they're like, look, here you go. But there, I promise you, there always is it's the thing you didn't see coming. And I thought about this as someone who led capital markets for a lot of years. The thing you hedged for wasn't the forward yield curve. It wasn't that. It was the thing you didn't see coming. On March 1st of 2020, pretty sure we didn't know what a COVID was. And even though you could argue you should have seen it coming in early 2007, we were all going, housing's going to absolutely collapse. So it was those sorts of things, certainly terrible things like 9/11, those kinds of things. And it's those things that you don't see coming that you need to try to be prepared for by creating an organization and a personality that is resilient. And secondly, orienting your brain to think. Someone was talking to me today, I don't know how it came up, about when they were in business school, how they had to listen to two side-by-side conversations. One was the conversation between the two pilots that took the airplane into the Hudson. Sully, I think was his name. And the other was between the people that were captaining that ship that giant freighter or oil tanker that ran aground in Italy. In the case of Sully, you had these two people that were incredibly well trained, who like flipped right into that train mode, that were resilient and were operating with real professionalism. They were just like, there was not a hint of freaking out. Even at the end, when the air traffic controller was like, "Hey, you could land in Teterboro, you can land here," and he said, "We'll be in the Hudson." But he said it like, that was like a normal place to land. Then conversely, apparently, and I didn't hear it, but he was telling me about it, the conversations with that pilot or the person leading it they were just freaking out, screaming, yelling, whatever. And so I think about that. When you have a leadership team, are you resilient? But have you trained yourself such that when the moment hits, and it's going to, COVID's going to, COVID, a 9/11, a financial crash, you name it, is going to happen. How will you reflexively pull in and go into the turtle shell, or will you be like somebody like Dan Gilbert, who's like, where's the opportunity here? To quote Warren Buffett, you buy when there's blood in the streets. That sounds easy. That's very hard to do, which is why there's so few Warren Buffetts. But I think we can train ourselves to start to think that way, but you don't do it in the moment. You do it beforehand. And so when you think about firms, so this is a long way around the barn, so forgive me. So I don't worry about a particular firm, but things will emerge, and I think we can prepare ourselves to best optimize when they do.
That's a great answer. Bob, I want to just thank you for joining us today. I fondly remember a lot of the meetings I had back in the days when I was at Fannie Mae, and you were always a straight shooter and always had such great insights. So it's been just amazing to get to talk to you again.
Well, it's been a pleasure to talk to you guys. Great always to see you, Jeremy. I think a lot of our meetings, fondly. One thing I'll leave you with, this will be like, this will be a great way to pump you up though, Jeremy, but there's a lesson in that. And sometimes I get asked, as I'm sure you do, by younger people or people saying, "Hey, what should I do? How do I get ahead in this world?" They may ask it in a more articulate way, but that's really what they're getting at. And the answer is to make yourself the obvious choice. Well, that's okay. Well, what the heck does that mean? And that's where it's like and by the way, this is why, again, if you're young and upwardly mobile, meaning you're aspirational, I am such a fan of being in the office. You live your own life, but gosh, that is where all those things happen. These interactions happen. And I remember a lot of things where Jeremy being in rooms, and we used to have the market color meeting and these kinds of things. You knew who was giving thoughtful answers and asking thoughtful questions. You could see the people that you could, cook an egg on their brain. And then you could see the people who the other side of that. And I always knew that Jeremy was a very thoughtful person, very innovative. And I was always, sometimes you walk in a room and you're pleased to see that person because you're going to have an interesting interaction. So I always appreciated it about you, Jeremy. But I guess the lesson there is we should all aspire to be that person in those meetings. You want whomever the big boss is or whoever your peers are to be like, gosh, every time you open your mouth, that something is thoughtful, that is prepared, that is optimistic, that is, enthusiastic, and it goes a long way. So there you go.
Well, thank you. That is incredibly humbling because I've been looking up to Dan and to you for my entire career, and I continue to apply everything I learned constantly. And I think that curiosity that you still exhibit is what I tried to reflect, right? Just being curious and constantly asking, like, why do we do it that way? Why don't we do it this way? Is something that I internalized simply by working, for you and for Dan and being around that environment. So it's really wonderful to hear that it
Without
reflects
a
back.
doubt, the most powerful word in the English language, the one that 3-year-olds are so adept at using, is the word why.
Well, thank you very much, Bob. And thanks everybody for listening. That'll do it for Housing Insiders. Thank you for joining us. And please remember to email us at podcast@thehousinginsiders.com. If you have an idea for a show or a guest, and if you'd like to hear more, please leave us that review.
And also hit subscribe and make sure you get episodes like this one in your regular podcast feed.
Thank you, as always, to Keenan Chen for the music.